Hello and welcome back to the TheRockFXHub. I'm Peter, or as most of you know me, Peter the Rock. It's great to have you here once again as we continue our journey through the audiobook and video training series based on my book, Forex Trading Fundamentals, a complete beginner's guide. If you've listened to or watched Chapter 2, you now understand how currency pairs work, what pips and spreads mean, and how leverage can shape every trade. Now it's time to connect that knowledge with timing. Because in Forex, when you trade can be just as important as what you trade. Welcome to Chapter 3, Market Sessions and Timing. In this chapter, we'll explore how the Forex market operates around the clock and how understanding global sessions can help you find your trading rhythm, improve your timing, and trade when the market is most alive. Here's what we'll be covering. 1. Session 3.1, the 24-hour market structure. We'll start by understanding how the Forex market runs continuously, 24 hours a day, 5 days a week, and how trading activity moves from one financial center to another across the world. 2. Session 3.2, the London, New York, and Asian sessions. Next, we'll break down the three major market sessions, their characteristics, volatility patterns, and the currency pairs most active in each. You'll see why London and New York dominate global volume, and why timing entries around overlaps can boost your results. 3. Session 3.3, best times to trade in volatility patterns. Finally, we'll discuss how to identify the most profitable trading hours, how to match your personal schedule to market activity, and how to avoid the quiet, low-volume periods when false signals are common. By the end of this chapter, you'll have a clear understanding of the Forex market's daily rhythm, when to be active, when to wait, and how to align your trading style with global liquidity. Before we get started, I'd like to remind you to subscribe to the TheRockFXHub, like this video, and share it with other traders who are learning just like you. That way, you'll receive a notification as soon as the next chapter. Chapter 4, Charting and Price Action Basics, goes live. So, get your notebook ready, stay focused, and let's dive into the heartbeat of the Forex market. Welcome to Chapter 3, Market Sessions and Timing. Chapter 3, Market Sessions and Timing. Session 3.1, the 24-hour market structure. Page 1. One of the defining features of the Forex market is that it never truly sleeps. Unlike equities or commodities, which trade on specific national exchanges with fixed opening and closing bells, Forex is an over-the-counter, OTC, global network that operates continuously from Monday midnight GMT through Friday 2200 hours Greenwich Mean Time. Trading follows the sun around the globe. When the trading day ends in one financial hub, it begins in another, creating a seamless, rolling cycle of liquidity. The major centers are Sydney, Tokyo, London, and New York. This sequence ensures that, at almost any moment, at least one region is active and providing pricing. The Forex day unofficially begins in the Asia-Pacific region. Sydney, Tokyo, London, New York, Sydney again. Institutional desks refer to these as sessions. Each has its own character, driven by local participants, news, and economic data releases. Traders use the session rhythm to time entries and gauge volatility. Because the market is decentralized, weekends are the only time it closes. Even then, political or macroeconomic events over Saturday through Sunday can cause gaps when prices reopen. Understanding this continuous structure helps you avoid surprise volatility and plan rest periods, critical for maintaining discipline and focus. Page 2. Each session overlaps slightly with the next, producing periods of heightened activity when liquidity from two regions coincides. The most famous is the London-New York overlap, often regarded as the busiest trading window of the day. For retail traders, this global continuity offers both opportunity and risk. You can trade nearly any hour. But that doesn't mean you should. The quality of liquidity and volatility varies dramatically. During quiet hours, for instance, the late U.S. afternoon, spreads widen and price action tends to drift. During overlaps, spreads narrow and movements accelerate. Time zone awareness is therefore a practical skill. Many traders set their charts to GMT plus 0 or New York time ET as standard reference. Most platforms also mark session boxes or colors, tools that help visualize when markets are likely to be most liquid. Professional traders often define a personal trading window, a 3 to 4 hour block that aligns with their preferred session. The goal is consistency, not constant monitoring. Recognizing the global 24-hour rhythm allows you to structure your trading days strategically, matching your personality and schedule to the most suitable liquidity cycle. Page 3. The 24-hour nature of Forex also affects news flow and volatility distribution. Key economic data are released at local business hours. Japan's GDP in the Tokyo morning, UK inflation at London Open, US, non-farm payrolls mid-morning New York. Each release generates volatility concentrated within its session. This geographic timing is why traders who specialize in certain currencies, like US dollar to Japanese yen or pound sterling to US dollar, tend to focus on the sessions where those currencies' home markets are active. If you trade euro to US dollar, the London and New York sessions will dominate your attention. For Australian dollar to US dollar, Asia, Pacific hours matter more. In sum, the 24-hour FX structure gives unmatched flexibility, but effective traders impose structure within it. Choose when to trade, when to rest, and when to observe. Treat time as capital. Expend it only when probability and liquidity align. Session 3.2, the London, New York, and Asian sessions. Page 1. Each major Forex session carries its own signature. The Asian session, led by Tokyo, opens around midnight GMT and runs to roughly 9 o'clock Greenwich Mean Time. It is known for steadier, range-bound movement, smaller average daily ranges, and sensitivity to regional news, especially from Japan, China, and Australia. Pairs like US dollar to Japanese yen, Australian dollar to US dollar, and NZD/USD see most activity. The London session begins around 7 o'clock Greenwich Mean Time and remains dominant until mid-afternoon. London's geographic location overlaps with Asia's close and New York's open, making it the liquidity hub of the world. Roughly 35 to 40% of daily global FX volume passes through London desks. The New York session starts near 12 o'clock Greenwich Mean Time, 7 a.m. ET, and carries heavy influence because of U.S. economic data releases and dollar dominance in transactions. Activity typically peaks during the London-New York overlap and fades toward 2100 hours Greenwich Mean Time. Knowing each session's character allows you to plan which pairs, strategies, and risk settings fit best. Scalpers might prefer overlaps. Swing traders may favor the London morning's directional momentum. Page 2. Let's look more closely at the Asian session. Liquidity originates primarily from Tokyo, Hong Kong, and Singapore. Price action tends to consolidate after the U.S. close, producing narrower ranges. Volatility spikes occur when Japanese economic data or statements from the Bank of Japan surprise the market. Traders who operate during this time often employ breakout strategies, anticipating volatility expansion when London opens. Alternatively, mean reversion tactics exploit quiet Asian ranges. Because spreads are slightly wider, position sizes often reduce control cost. for AUD and NZD base pairs. The Asian morning aligns with domestic data, making it the prime window for those currencies. Many algorithmic traders monitor carry trade flows here, as interest rate differentials between Asian and Western currencies set the tone for global funding. Understanding this helps you avoid unrealistic expectations. You can't force volatility in a session that's naturally calm. Instead, you adapt by aligning your strategy with session behavior. Page 3. The London session is the engine of global FX liquidity. When European markets open, order flow surges. Banks square Asian positions, corporate hedge, and institutional traders initiate daily strategies. London's proximity to both Asia and North America makes it the perfect bridge. During its morning hours, volatility often expands as traders react to overnight developments. The Euro, GBP, and CHF pairs typically lead activity. News such as UK employment data or Eurozone PMI releases inject sharp moves. Because liquidity is deepest, spreads are tightest, making London ideal for day traders. However, speed cuts both ways. Rapid moves mean stop losses must be well placed. Experienced traders often employ breakout and trend continuation tactics at London Open, then scale down during the quieter midday low before the US. Overlap reignites action. Page 4. The New York session begins as London hits its stride. This overlap, roughly 12 to 1600 hours Greenwich Mean Time, is the most volatile 4-hour window of the day. The combination of U.S. data releases and European traders closing books creates strong directional momentum. Pairs involving USD, CAD, and Euro dominate. Non-farm payrolls, first Friday each month, can cause extreme moves across all USD pairs. Spreads are tightest, fills are fastest. Many professional traders plan their entire day around this period. After 1600 hours Greenwich Mean Time, London closes, leaving New York to trade solo until roughly 2100 hours Greenwich Mean Time. Liquidity gradually thins, volatility subsides, spreads widen again. For U.S. traders, this final window can still yield opportunities on late-day reversals or North American news, oil inventories, Fed speeches. The key lesson: understand when energy peaks and when it fades. Align your trading hours to when your target pairs are naturally most active. Page 5. Let's take a moment to compare the 3 main Forex trading sessions side by side. This will help you understand how each session behaves and which one might fit your trading style best. First, we have the Asian session, often called the Tokyo session. It runs approximately from midnight to 9 a.m. GMT. The main currency pairs traded here are US dollar to Japanese yen, Australian dollar to US dollar, and NZD/USD. This session is known for being calm and range-bound, meaning price tends to move within smaller ranges instead of making big breakouts. Liquidity is moderate, enough to trade smoothly, but not as intense as the later sessions. It's ideal for traders who prefer slow, controlled market movements or who trade the Japanese yen, Australian dollar, or New Zealand dollar. Next, we move to the London session, which starts around 7 a.m. GMT and runs until about 4 p.m. GMT. This is the heartbeat of the global Forex market. The most active pairs are Euro to US dollar, Pound sterling to US dollar, and US dollar to Swiss franc. London is known for being trendy and high in momentum, meaning prices can move fast and strong in one direction. Liquidity is very high, with many banks, institutions, and professional traders participating. If you enjoy active trading, tighter spreads, and clear trends, the London session is your sweet spot. Finally, we have the New York session, which starts around 12 p.m. GMT and runs until roughly 9 p.m. GMT. Here, You'll see heavy movement in euro to US dollar to Canadian dollar, and pound sterling to US dollar pairs. This session is volatile and news-driven, especially because major U.S. economic reports, like non-farm payrolls or inflation data, are released during these hours. Liquidity is also high, particularly during the London-New York overlap, which is the most active 4-hour window of the entire trading day. So, in summary, 1. Asian session, it's calm and steady. 2. London session, it's energetic and trending. 3. New York session, it's volatile and news-driven. As a trader, you don't have to trade all sessions. Instead, pick one that matches your lifestyle and energy. If you're an early riser in Europe, the London morning might suit you best. If you're in the U.S., you'll likely prefer the New York Open. And if you're a night owl in Asia or Africa, the Tokyo session might fit your schedule perfectly. The goal is consistency. Trading the same session each day helps you recognize patterns, develop intuition, and sharpen your edge over time. Session 3.3: Best Times to Trade and Volatility Patterns. Page 1. While the Forex market operates 24 hours, not all hours are equal. The best time to trade depends on volatility, liquidity, and your chosen pairs. The general rule: trade when market participation is highest and spreads are narrowest, typically during overlaps. The London-New York overlap, 12 to 1600 hours Greenwich Mean Time, consistently offers the most robust volatility. Major economic releases from both regions occur here, driving strong price movements. Conversely, the late U.S. afternoon after 2100 hours Greenwich Mean Time is the quietest period, best suited for analysis or rest rather than new trades. Volatility follows a cyclical rhythm. Calm build-up, spike fade. Skilled traders learn to anticipate these transitions, entering before the spike and exiting before the fade. Session-aware timing transforms random participation into strategic engagement. Page 2. Statistical studies show that daily volatility clusters around session opens. For example, euro to US dollar often sees 60 to 70% of its daily range occur between 7 o'clock and 1700 hours Greenwich Mean Time. This reflects when banks, funds, and corporates adjust positions and release orders. Another pattern: volatility expands on Tuesdays, Thursdays, and contracts on Mondays, Fridays. Monday opens digest weekend news. Friday closes positions before weekend risk. Traders use these tendencies to schedule heavier or lighter exposure. Awareness of volatility patterns helps set realistic targets. Expecting a 100-pip move during quiet Asian hours is unrealistic. During London-New York overlap, it's plausible. Matching expectations to session dynamics prevents overtrading and disappointment. Page 3. Understanding timing also aids risk management. Liquidity gaps during low-volume hours increase slippage risk. Stop losses can trigger at worse prices. Conversely, trading during high liquidity overlaps means tighter execution, but also sharper whipsaws. Each environment demands adjusted stop distance and position size. For part-time traders, selecting one active window within your daily schedule is pragmatic. Document its typical volatility, news cadence, and spread range over several weeks. This builds your personal volatility map. A crucial edge: professional traders treat time as an input variable, not background noise. Mastery of timing transforms Forex from chaos to rhythm. Page 4. Different currency pairs peak in volatility at different times. 1. Euro to US dollar, pound sterling to US dollar. Strongest during London, New York overlap. 2. US dollar to Japanese yen, Australian dollar to US dollar. Most active in Asia and early London. 3. US dollar to Canadian dollar. Peaks during US and Canadian business hours. Aligning your chosen pairs with their native sessions yields clearer trends and less frustration. Many traders focus on one or two pairs and learn their timing intimately, akin to understanding a musical rhythm. Technology aids timing. Economic calendar alerts, volatility dashboards, and session indicator overlays allow precise preparation. Yet discipline remains paramount. Trading outside your planned hours erodes consistency. Page 5. Finally, we address the psychology of timing. Many new traders equate more screen time with more opportunity. In reality, profitability comes from trading less but better. Identifying the hours where you are mentally sharp and the market is liquid yields higher quality decisions. Adopt a ritual. Pre-session analysis, active trading during your window, post-session journaling. Then stop. This rhythm mirrors how professionals operate. The 24-hour market tempts constant engagement. Discipline lies in selective engagement. By understanding sessions, overlaps, and volatility patterns, you align your lifestyle and strategy with market behavior, not against it. In doing so, you transform time from an enemy into an ally. And that brings us to the end of Chapter 3. Market Sessions and Timing, from the audiobook Forex Trading Fundamentals, a complete beginner's guide. In this chapter, we explored how the Forex market flows across the globe 24 hours a day, how each trading session, London, New York, and Asian, carries its own rhythm, and how timing your trades around volatility can make all the difference between random results and consistent success. Remember, trading is not just about strategy. It's also about timing, discipline, and patience. Knowing when a trade is just as powerful as knowing how to trade. Up next, we'll continue building on this foundation in Chapter 4. Charting and Price Action Basics. In that chapter, we'll dive into how to read Forex charts, understand different chart types, and interpret the story price tells without relying too heavily on indicators. It's one of the most important steps in becoming a skilled and confident trader. Before you go, don't forget to subscribe to the TheRockFXHub, like this video, and share it with other traders who are learning alongside you. Hello and welcome back to the TheRockFXHub. That way, you'll get a notification the moment Chapter 4
I'm
drops.
Peter, or as
You'll
most of
stay
you
on
know
track
me,
as we move deeper
Peter
into this
the Rock.
complete Forex learning journey together. Thank you once again for listening. I'm Peter the Rock, and I'll see you in the next chapter. Until then, stay focused, trade smart, and always keep learning.